The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everybody. Welcome to our live webinar, Guaranteed Lifetime Income Solutions, Solutions for Providing Employee Retirement Income Security. On behalf of the entire team at Dietrich & Associates, I would like to thank you for tuning in to our live session on what we feel is a very important and hot topic today. My name is Krista Dietrich, and I'm your conference organizer this afternoon. I'm from our Tampa, Florida office. Before I introduce our presenter for today's session, I'd like to ask you to please try and save your questions until the end of the presentation. If you have any questions that cannot wait, we will try to answer them as they come in. Questions can be asked and sent on the question area of your GoToWebinar control panel. Any questions that are not answered today will be answered offline after the live session as well. Our presenter for today's session is Jeff Dietrich, who is tuning in from our Philadelphia office. Jeff has been with Dietrich & Associates for nearly 15 years, working directly with plan sponsors, their advisors, ERISA counsel, and the most secure life insurance companies in the country to provide custom retirement plan solutions for individuals and corporations. His knowledge of the history, purpose, operation of defined benefit plans affords him a unique insight into the importance of guaranteed income in retirement and the lack of solutions provided by today's retirement plans. So without further ado, I'd like to turn the presentation over to Jeff.
Thank you, Krista. Good afternoon, everybody, and good morning to our left coast brethren. Get this show going here. We're going to start off with a little bit of a history lesson and background on Dietrich & Associates, and then we're going to get into our K-annuity model, and then we'll open this up for discussion. So without further ado, I think I'm going to say some things that can be debated today, and I think it's to start, it's debatable whether it's an employer's responsibility to provide retirement income security anymore. But I think it's undeniable that they have the trust of their employees and also a vested interest in their well-being. What you're looking at here is a little bit dated, but it's a slide that shows the decline of the defined benefit plan. Roughly 75% of the plans that were around in the early 1980s are gone. And we're very familiar with that here at Dietrich & Associates as we've helped terminate many of those plans. Our history is deep in helping plan sponsors alleviate liability through transferring that liability to a safe insurance company to guarantee and administer those future pension benefit streams. So we know all about guaranteed income. We have a good idea as to the trends, the marketplace, and do have some DC experience over the recent past here. As I mentioned, the DB plan is a dying breed. Of the plans still active, only about 60% of them are still accruing benefits. They're mostly smaller employers. I think we can assume that they're mostly older employees and probably a lot of professional shops, as opposed to larger employees where most of America's workforce is. So what that means is there's been a monumental shift in the approach to retirement readiness. And as this shift has been happening, I mean, DC plans are 30 plus years old, but as this shift has been happening and DB plans have been going away and the generations have been moving through the workforce, it's becoming apparent the shortcomings of the 401k plans. They were designed as a supplemental savings plan, not a retirement income plan. And as the baby boomers come to retirement and as future generations will, we'll see this become more and more apparent if we don't address it. I think the main deficiency in a defined contribution plan is that it puts everything up to the participant, whereas with the defined benefit plan, the risk of managing the assets, the decision making was the sole responsibility of the plan sponsor, as you can see here. And this chart will show us the differences between the plans. The shift is now a participant level requirement, a participant level risk, more of a focus on accumulation. Again, that's by design in DC plans. What we're starting to see through industry groups, through the government, and some forward-thinking plan sponsors is that DB mindset coming back, a refocus on income. A lot of this is brought on by the baby boomer generation and the magnitude of the amount of people that are entering retirement age. I don't say entering retirement, I say entering retirement age. We'll get into that more. But we see more of this DB thinking coming back. The government, the Department of Labor, has posted a pretty lean safe harbor for DC plans that want to offer income solutions. The Senate proposed a lifetime disclosure bill that I believe died in Congress. So there's rumblings out there. Our position is that you necessarily can't count on the government to put this into plans. So really it comes down to industry experts and ultimately the plan sponsor. As we mentioned, today's primary retirement plan is the defined contribution plan. And what we see is that there are inadequate savings, mostly for the younger generations. The folks that are nearing retirement, the baby boomers, some of them have been the benefit of DB plan rollovers that have helped fund their 401k or other DC plans. So they may have the balances necessary to enter retirement, but those balances were hit. Those balances, as we all, I'm sure, remember 2008 and the recession that followed, a lot of our balances were hit hard, 30% and upwards. And while they've rebounded, the apparent risk in the model of the savings vehicles of an IRA or a defined contribution plan, it became real. And it became more real for those folks that ran scared, that kind of said, I'm going to cash in my chips and take it off the table and realize those losses. And that's the undereducated participants that we're really focusing on here, and that we think that employers need to turn their responsibility to. On top of market volatility and inadequate savings, people are living longer. I point to the last bullet point there that says a couple age 62 today, there's a 50% chance that one of them is going to live to age 90. Now remember that age 90 because that's important later in the presentation. So going back to a theme that we're trying to establish early here, employer paternalism, it was a theme that ran deep in the defined benefit plan model, and apparently, almost 4 out of 5 employers still feel that way, but less than 1 out of 5 feel that their employees are prepared. So there is a disconnect there. So the underprepared workforce, mostly seen right now in the baby boomer generation that's coming to retirement. They're not necessarily, as I mentioned earlier, they're retirement age, but they may not be retirement ready. Studies show 45% of boomers run the risk of outliving their retirement savings, and that's the longevity risk that we talked about. 1 in 4 workers have completely diminished their retirement savings, and 2/3 of American workers, within 20 years of retirement, plan to delay retirement. And what does that mean? That obviously means that we're not prepared as a country, as a system for retirement. But from a business perspective, that means that we have an aging workforce. Not to put down older people, but we all know that as we get older, we become less effective at certain things. The costs are greater at providing benefits in time for older workforce, and it deters company growth. So from a business perspective, employers, if they don't have that paternalistic view, then they should, from a smart business perspective, consider the retirement readiness of their population, because their net impact really is higher costs. I call this slide perception, and perception is powerful. What this is showing us is how confident Americans are in a comfortable retirement. And immediately you look to 2009, and everybody can expect that and appreciate that. But what this shows us is that we've only bounced back a little bit. The years prior to 2007, I think it would show probably similar results as the years following 2009. Is that Americans really aren't too comfortable with retirement, and that those folks are primarily those baby boomers that are coming to retirement, and I question whether this is due to a lack of retirement income and a lack of understanding of the amount of income necessary in retirement. I say this for younger generations too. I myself am a Generation Xer, and if I wasn't in this business, I wouldn't know what a pension was or guaranteed income. My advisor doesn't talk to me about it. I know what Social Security is, but frankly, I don't have a lot of faith in it. And I know my friends feel the same way. My one buddy, John, sums it up nicely. He says, retirement is a dead ideology. So how's that for perception of a younger generation that is in the middle of their working prime right now? So that's perception. What's the reality? This chart does a nice job of showing what income is required to replace or to provide for income. What kind of savings is required to provide for income in retirement? And I'm going to point to the person age 65, someone coming to retirement right now, say that they're making $50,000 a year. They have a 60% income replacement ratio or $30,000 a year income in retirement. They'll need a nest egg of $600,000. I don't know many 65-year-olds with $600,000 in their retirement plans and IRAs or savings accounts. They may have it locked into their houses or a little bit here and there, but that's a pretty big number, and that points to the underpreparedness of Americans in entering retirement. And it also, as I mentioned earlier, translates to younger Americans who hope to have retirement like myself. So we understand what it takes to retire, or have a little bit of an idea of it based on some statistics. And here's a little bit more statistics on how employers feel. Again, going back to the entity that really has the opportunity to provide guaranteed income options and help secure that retirement. And I tie guaranteed income options and security together because that's exactly what it is. A guaranteed income option is guaranteed. It's going to provide you an income in life that you can't outlive. 85% of plan sponsors feel that their employees are not prepared for retirement, and 72% of them consider it very important. Yet only 20% have ever assessed retirement income or projected retirement income for their participants. So again, disconnect. What do we believe here? I'm of the belief that from the employers that I talk to, there are still many paternalistic employers out there. And income is important, but there's these perceived hurdles. And those perceived hurdles are in the model of the defined contribution plan, which, as we can see here, again, defined benefit plans falling off, defined contribution model on the rise as the primary retirement plan. Put some numbers to that. You look at the Q2 2013, the bottom two numbers here, the orange and the blue, make up your savings model, your IRAs and your defined contribution plans. $11 trillion in assets. Over half of the total retirement assets in the market are in this model. A model that has no inherent way of turning that savings into income. And a participant base that doesn't understand how either. I say no. You'll see here 16% of employers do have a form of retirement income option. A lot of those are your old 403B plans, money purchase plans, and whatnot. But the important thing here is that 88% of participants say they would prefer this, a steady income stream in retirement. So there is an understanding of it, but where's the disconnect? They would prefer some kind of income, but what is income? Is income a guaranteed minimum withdrawal benefit? Is it a target date fund? Is it an annuity? Annuities have bad connotations, and that's what we're talking about here today. But it's an education. It's a misconception. Perceived or lack of perceived, knowledge on these products, and I think that's what the industry wants. The industry is approaching retirement the same way that defined benefit plans over the years have approached funding. Let's skew the numbers. Let's try to earn our way out, reduce our contributions, and let's see what happens. And cross our fingers and hope that maybe the government will come in and kick the can further down the road and give us more relief. And the reality of it is that the only true form of a guarantee or secured income is through an insurance-based product like a fixed annuity. And that's what we're talking about here. So while the industry is making steps in the right direction, we feel that it is coming from the wrong angles. It's coming from a participant-level angle, and it's coming from an investment-centric approach as to a guaranteed, first-party guarantee between you and the insurance company, and systematic approach over a working life. So bought and paid for pieces of income over the working life, and not waiting until you're in the position to retire. And that's what we're showing on this slide is the key tenets of Dietrich and Associates' approach to DC income solutions. Our first, it's twofold. The first is your traditional single premium immediate annuity. We call it our Dietrich annuity, and our Dietrich annuity is our automated system that connects plan sponsors and their participants to the market of insurance companies that provide these solutions. We propose it as an in-plan, employee-directed income option. Again, this is for folks when they come to retirement, they can take a portion of their savings through the plan, purchase this annuity. It's the employee's decision on who to purchase, who to go with, but it is the employer's decision to add this option. Our accumulation solution is known as the K annuity. In the K annuity model, we take the employer contribution or match, and we buy pieces of income over the working life of the participants. So for discussion purposes, we're going to talk about it on an annual basis. So annual deferrals, or not deferrals, annual matches or discretionary profit-sharing contributions on the part of the employer will buy, again, paid up front, bought and paid for pieces of income for each participant as that contribution is made. There are some benefits to this, and we'll get into that a little bit later in more detail. But one of the biggest, I guess most apparent benefits is the averaging of interest rates in this model. Let's go back 30 years and pretend that when DC plans started, we had this approach in there. If you were buying pieces of income for participants, there's two pieces of buying power that I'm going to get into, but think about it from an interest rate standpoint. In the interest rates in the 80s that make me salivate as somebody that wasn't able to participate in that, and I know there's positives and negatives to everything, but for purely this argument, you're buying pieces of income in double-digit interest rate markets over a 30-year working life for a participant. You're going to have a nice chunk of retirement income, and you're not going to really be exposed to the interest rate risk of the last 10 years because you've offset that, you've hedged that with those prior 20 years worth of purchases. The design of the product, while it has a liquidity feature and allows for portability and cash out. It's designed to limit that, and that is to get the most value out of that income, get the biggest bang for your buck in buying retirement income. Again, we're looking at an income solution here, not an investment. We're looking at the employer's contribution. The employee can still wheel and deal out in the market with their deferrals. But we're saying, Mr. Employer, this is one way that you can help ensure comfort, retirement readiness for your employees, and do so with your contribution, which is just a fraction of the pie, really. So we're not saying it's everything. We're saying it's a piece. In our model, you have choice. As opposed to your participants when they retire going down the street to their local agent or advisor, where they may be dealing with one insurance company or maybe a couple. We have a choice of a market of nearly a dozen Department of Labor 95-1 safest available insurance companies. And what that means for those of you that aren't familiar is in 1995, the Department of Labor issued a safe harbor for defined benefit plans that terminate. And when they terminate, what they have to do to transfer those benefits to ensure that they're with a safe company that's going to be around to administer and guarantee those benefits. Excuse me, and that's what we do day in and day out. We analyze those companies, we work with those companies. And through our K annuity and our Dietrich annuity offerings, we're bringing those companies to the DC marketplace. You say, well, wait a minute, look at this. This kind of looks like a defined benefit plan, and that's what the purpose of this chart here is to show you the differences between, as we talked about, the contributions aren't mandatory like defined benefit plans. Defined benefit plans, they're decreasing for a reason. They're costly. They're over-regulated. They're not recognized by employees, the younger generations, as a benefit as much as necessarily the DC model. So, in our model in the K annuity, it's not a required contribution. That's a DB thing. Ours is discretionary, just as your match. Or your safe harbor, which is somewhat discretionary if you want a safe harbor, or your profit sharing, discretionary contribution. If you're having a bad year, you don't have to do this. Funding, it's exactly what you say it's going to be. It's not based on increasing salaries or some fictitious rates of return, assumed discount rates in mortality tables. Interest rate, mortality risk, and administrative costs. The big downsides to defined benefit plans, in our model, they're transferred to the insurer. Again, it's bought and paid for. Just like when you're terminating your defined benefit plan, you pay out your cash or you transition your employees to the insurance company through a group annuity contract, you're doing the same thing here. While the benefit itself lives inside the plan, there is no investment mortality risk and minimal administrative costs because, again, that is being shifted to the insurance company. And no impact on the financial statements. Last year we saw General Motors shift nearly $30 billion of pension liability off their balance sheet for that sole purpose because it had become too big for the company. They had become a car company that insured pensions. So they got rid of that. In the defined contribution, or in the K annuity model for defined contributions, there's no impact because this is not an employer liability. This is a bought and paid for insured product. We talked about buying power, and earlier I mentioned that there's really two aspects to buying power. The first aspect, we're going to call it institutional versus retail. As I mentioned, right now your participant leaves your plan and they have the option to go and do whatever they want. They're subject to the retail market. So they go across the street to State Farm and say, I want to buy a single premium immediate annuity that's going to, with my $100,000 that's going to, get me whatever it's going to get me a month for life. Well, it's great thinking because that's what we're talking about here. I think that's important. Income for life that you can't outlive. But what you've done by not allowing them to do that in the plan is you've ultimately decreased their buying power by almost 10%. and that's because of the differences between retail products and institutional products. If you offer annuity income products, the Dietrich annuity or the K annuity, in your defined contribution plan, you can take advantage of institutional mortality, which is group mortality versus individual mortality, which I'm sure you can understand from the healthcare industry. Commissions are a lot lower on institutional products, and there's competition, as I mentioned earlier. We're bringing multiple companies to the table, and they're competing for your business. The second and final illustration of buying power is what I alluded to earlier, and that's saving early. As you can see in this chart here, and I'm going to try to go slow because there's a lot here, but at the top we're looking at the contributions, and at the bottom we're looking at the benefits that those contributions generate. And we're looking at it over 4 different examples, starting at an age of 25, 30, 40, and 50. And we're going to assume the same salary for that person regardless of age, $40,000 a year. And we're going to assume a employer matched discretionary contribution of 4% of salary a year. And we're going to look at what that can buy in monthly benefit, starting at those different ages. And as you'll see, and as I'm sure you figured, you're going to buy a lot more benefit when you start at a younger age. And where you really see the compounding here is the total payout. You have the guaranteed payout, which is really just a product of the 15-year certain feature of the annuity that we're using in this example. It's a life and 15-year certain, so you're going to get paid 15 years whether you're alive or not. After that point, if you're still living, it'll continue to follow you until you die. And that's the total payout at 90. We used that in age earlier, 90, where one person of each couple has a 50% chance of living to 90. Well, there's your return if you live to 90. And that's really in this product, if you live to or beyond life expectancy, that's where you really see your return. Prior to that, it's the security, the guarantee of the income stream. The last line under benefits shows you salary replacement. So we go back to that income replacement ratio, and the bottom line here is that for an employer's contribution of 4%, starting at age 25, and assuming that person worked to 65, they can provide 23% income replacement on that $40,000 salary, just their portion. I think that is astounding. At the very bottom, what we're showing you is the current practice today, is taking that savings. So in the case of the 25-year-old, take that $64,000 in contributions to market today. That's going to buy you $338 a month for a life and 15-year certain. $450 almost less than the K annuity model. You say, wait a minute, Jeff, you're not counting, returns. You're not counting, 40 years of investing that $1,400 or $1,600 a year. And while we could argue that, there's timing, there's, market history, history doesn't determine future returns. But I'll give you that, and we'll look at it at $100,000. $100,000 only buys you $530 a month today. And in fact, it would take about $148,000 to buy that $779 that the K annuity produced if you were in today's market. One final thing to leave you with on this chart is that we're using today's interest rates. We're using today's interest rates in the 40 years of calculations for that 25-year-old. So we're not looking back to the 80s when there were double-digit interest rates and coming up with that $780 a month. We're not looking forward into an increasing interest rate market that we all think is going to happen when coming up with that $780. We're using today, which is some of the lowest interest rates since the Great Depression. Yet it still outperforms a lot of other items out there. And again, we're only talking about the employer's deferral. This is the same chart for the visual learners out there. The blue represents the contribution, the red represents the guaranteed payout, and the green represents the payout at age 90. As I mentioned earlier, you can really see you get your bang for your buck if you live longer, which everybody's trying to do, and we're doing a better job of. All right, so you like what you hear. You say, Jeff, I want the K annuity, or I want the Dietrich annuity, you know, but my record keeper says they can't record keep it, or my advisor says, nah, you don't want to do that. You don't want to buy an insurance product. What do you do? There's interest. There's interest in providing retirement security or helping your participants at least understand what it is. What I say is come to Dietrich, because we can help. Like I said, we have 30 years of doing this with defined benefit plans. We understand a model that has worked. I don't think anybody can argue that the defined benefit model has worked. And we've helped guarantee hundreds of thousands of participants in defined benefit plans. We can help with the perceived fiduciary exposure through the due diligence that we do day in and day out already. We can assist with the participant education that we already assist with in DB plans that offer lump sums and annuity options. We can also reduce administration and record-keeping expenses with our model and tie the whole thing together for you. We're your go-to income solution source. So at this point, that wraps up my monologue. Thank you, everybody who has hung on. And my contact information is here if anybody would like to reach out to myself or Krista or anyone else here at Dietrich & Associates. You can find us online, K Annuity, Dietrich Annuity. You put those two words together, we're out there. And I think, Krista, we're going to open it up to questions now.
Sure. Anybody that has any questions, go ahead and put them in your window that you see there. I've got one already. The question is, how often do our clients or people that we're talking to approach or ask us about lifetime income solutions?
That's a very interesting question, and then I'll use an analogy to life insurance. How many people ask about life insurance? Insurance products need to be sold, so it's really something that we're out there spreading the word of. If you think of the defined contribution model and the players involved, taking money from the defined contribution plan and giving it to an insurance company as opposed to an investment manager, that really is against that investment manager and every other advisor on that plan's business model. So it's not something they're going to bring up unless it's one of their synthetic products that I mentioned earlier. So really, plan sponsors aren't approaching us. It does happen, but it's something that really needs to be sold and understood because it's not talked about out there. I'll liken it to pension risk transfer too. Something else that we're deeply rooted in here that is a concept, a risk-reducing concept that really needs to be sold. So some, but not a whole lot. But you can see from the statistics that employers and employees alike feel that it is a necessity.
Great. Another question coming in. What guarantees are provided in the marketplace for deferred annuities?
The guarantee is as good as the insurer providing it, and that is part of the review of the insurance companies and part of the reason you only deal with the top-tier insurance companies that we really bring to the table and represent here. These companies have been providing guarantees for, in some cases, 200 years, but in most cases, 100 and over 100 years. That's the type of companies that we're dealing with. The product itself, not only is it designed to do what we say here, but it also has what is known as state guarantee insurance backing. Each insurance department in each state provides a level of guarantee for certain insurance products, and the product that we use here falls under that umbrella. It's important that that be known. It is not a selling feature or purpose, reason, but the product that is used is backed by state guarantee associations. Those limits usually run from 200 to 500,000, and because of that, our model is designed to diversify, to take advantage, exactly what diversification is supposed to do there. So it's really the underlying guarantee of the insurance company that is putting the paper out there.
Great. We've got another one here. Are my contributions going to purchase an annuity annually? Is it always from the same company from year to year?
That's a great question. I kind of alluded to that a little bit in the last response. There is a diversification feature here. If you're talking about the Dietrich annuity model where it's the employee's choice, you mentioned me, so that would be your choice. If you want to diversify, you can take your $100,000 and put $20,000 with 5 different insurance companies. In the K annuity model, it's kind of baked in diversification feature that we do use multiple insurance companies. So there are multiple guarantees and multiple levels of protection.
Great. Another one in here. Would this program dovetail with your de-risking for a DB plan?
Oh, it sure does. And the first question about it, how many plan sponsors are approaching us, it's a natural way for us to approach plan sponsors after we're introduced and get to work on their defined benefit plan. We can introduce this as a replacement option, and we can actually model it to mimic or match the defined benefit that they provided before they terminated that plan, if that is something that they want, something that their employees may recognize or appreciate more because they've seen it. So yes, definitely.
Great. Can you do one-off annuity purchases for specific participants? Would that be the Dietrich annuity product, and is there a minimum purchase required?
Yes, that is the Dietrich annuity product. There is no minimum. Well, let me retract that. It's that old $5,000 threshold, really. But because of the market of companies that we have, they have different underwriting requirements. So you may limit the companies that, on the smaller side, the companies that that will approach you. But there should be no less than 6 companies. And really, there is not a minimum. And yes, that is the Dietrich annuity model platform. You can find that at www.dietrichannuity.com. It is password protected, but on the site you can request a password.
Great. And another question. What's the death benefit on this annuity?
On the Dietrich annuity, your typical SPIA, the death benefit is whatever is inherent in the form. So if you have a joint survivor and you die and your spouse outlives you, there would be a continuation to the spouse, or as the example we used with the period certain, it would be a guaranteed number of payments. There are cash refund features. In the K annuity model, as I mentioned in the question about, can we dovetail this with the defined benefit plan, we work with the plan sponsor to design the plan that they want, and a lot of it is based on the way that defined benefit plans were written. So at a minimum, the death benefit is the principal plus a nominal interest, but the death benefit really is flexible and can be whatever the employer deems appropriate.
Great. We've got another one here, kind of similar to a question asked before. Given the multiple insurance carriers, who issues the gross annuity payment at retirement?
That's a great question, and I'm not really at liberty to say right now. We can take that discussion offline and follow up with you one-on-one with that question.
Great. Well, that
there is a.
Go ahead, Jeff.
I'll just add to that, say that there is a process in place to consolidate those payments.
Great.
But the guarantors are still the underlying insurance companies with whom each benefit was purchased.
Great. We've actually got one more that just came in that will slide in there. What What about longevity annuities with a deferred annuity starting at 85 and purchased at 65 to 70? Is there a market of competitive products?
I believe so in Europe. And there are some discussions that are starting here, and once we learn about them, I'm sure we'll be talking about that as well. It is an interesting concept and potentially a viable solution in certain cases, but really it's the fact that people are recognizing longevity risk that is the important thing here, and whether it's a paid-for K annuity, a Dietrich annuity at retirement, or a longevity annuity that you're buying somewhere between retirement and 85. Income solutions are, I think, here to stay. They're a necessity in retirement. If folks in my generation want to retire, we're going to have to help the folks ahead of us retire, and that's what we're trying to do with these solutions. So, yeah, not here yet that I know of. There's a lot of chatter, but I don't have a whole lot to share on that.
Great. We've got one more. Do you work with both record keepers and advisors?
Yes. There's kind of a natural synergy or connection there. I think one way to think of us is really an open architecture platform, to use a term from that industry. We work with anybody. Our product can be tailored to really bolt on to either product. The K annuity or the Dietrich annuity can really be bolted onto any existing system as long as you have you're an open-minded record keeper or advisor. And if you aren't, we have ones that are willing to do that for you as a plan sponsor.
Great. We've got one more here too. They keep coming in. How is buying deferred annuities along the way better than buying an immediate annuity at retirement?
We showed that example. If I understand the question correctly, I'm going to go back to this slide here. So if you look at age 25, somebody that's been buying deferred annuities over their working life, they're resulting in $780 a month, whereas if they took that same amount, or let's just talk about it, what would it cost today to buy $780 a month? It would cost roughly $148,000 to buy an immediate annuity right now. The underlying principle in this is that at a younger age you can buy more benefit. So if you're 65, the insurance companies, they're in payout mode, whereas if you're 25, they're in investment mode, and they're able to credit you a higher interest rate, so to speak, over a longer period of time. So you have more buying power as you're younger. Somebody that's 25, for the same amount of money, is going to be able to buy twice as much as somebody that is age 50, because they're closer to retirement. So it goes back to buying power. Further you get into it, interest rate averaging. So I'll use the example of somebody coming to retirement last year at 65, or even better yet, go back to 2009. Somebody coming to retirement that's got a depleted 401k balance and is in a terrible interest rate environment. Now that person versus the person who had been buying pieces of income over the prior 30 years through booming interest rate markets and investment markets, and at a younger age with that buying power, hopefully I painted that picture well enough that you can see the benefit to buying early deferred pieces as opposed to waiting. When you wait, you're at the risk of the market scenario at that time. You're at the mercy of the market. If you're retiring in 2009, that wasn't a great time to be doing that approach, or 2013 for that matter.
Great. I think that just about sums up. That's about the amount of time we've got today. I hope that everybody enjoyed this session and walked away with a lot of great information. Thank you, Jeff, so much for making it so informative.
You're welcome. Thank you, everyone.
And that will conclude today's live session, everyone. Thank you for tuning in. A link to our YouTube page will be emailed out to all attendees where you can view all of our recorded webinars, including this session today. Also keep an eye out for our upcoming webinars in our Retirement Income Series and our Pension Risk Transfer Series as well. We hope you have a great rest of your afternoon. Thank you so much.